mentioned before. And I want to challenge you with that. So Ray's going to come up. He's going to talk to you about money, credit, things like that. And then I'll talk to you a little bit more about some other opportunities that you have available to you as far as money goes. Who needs money to do more deals? Okay, me too. So we're going to talk a lot about that tonight. So let's welcome Ray Antonelli.
Okay, again, 18 years of mortgage loan origination. I've been originating all types of residential, commercial loans, that sort of thing. I've been a real estate investor. I've taught classes and seminars and webinars since 2004. That's enough about me. Benefits of attending. This will most likely be the most down-to-earth, actionable class you will attend all year. I don't teach overall concepts. I teach stuff that you can actually use tonight when you go home to look at your credit, okay? And of course, don't hesitate to pick up the phone and run a question or scenario by me on real estate or credit especially. And what you will not learn today, this is not a history of the industry, not an overall view of the credit markets or banking industry. It's not a philosophical discussion. Everything I teach, an actionable item that you can put to use today. Okay, why is good credit so important? If two people are applying for a job and one has excellent credit and the other has terrible credit and they're both pretty much equally qualified, typically the one who has excellent credit is going to get the nod, okay? Now that shouldn't be. In fact, during the depths of the recession that we just came out of, Congress was going to pass a law stating that you couldn't discriminate against someone based on if it wasn't a cash-sensitive job like a teller or a CFO or somebody like that. If you were a salesperson or a construction worker, you shouldn't be discriminated against just because your credit was not up to snuff, because a lot of people, literally millions of people, lost their jobs in the downturn through no fault of their own. Just because, you know, we were in that recession and business was contracting. So your score determines how much you will pay for even home and car insurance, as well as mortgage insurance, and whether you will get a job, and of course, if you will be approved or denied for a loan. To give you an example, my son bought a home in Solon about 5 years ago, and of course, I referred him to my State Farm agent, who I've had a long-standing relationship with. So I called up my State Farm agent, and I said, you know, my son wants to buy this home, and we need homeowner's insurance on it, and he said, great. What's your son's social security number? He didn't ask for the address. He asked for my son's social security number because he wanted to check his credit to make sure it was up to snuff enough that State Farm would even be willing to do business with him, okay? Or give him a good rate as opposed to a terrible rate. So good credit is important for a lot of different things besides whether you get qualified for a loan or not, okay? Knowledge is power. You'll hear me say this regularly, okay? Everyone should get a copy of their reports and scores at least once a year. It's very common to find errors on your credit report. Now, some of the errors are pretty benign, like, you know, they don't have the right job on there, or you might have a wrong address. But there are, in many cases, a lot of negative information on the credit report that should not be on there. And of course, negative information typically means your scores are going to be lower than what they should be. So you should always check. If you're planning on making a major purchase, start early. It takes at least 30 and sometimes as much as 90 days to have a correction done on your credit report. And part of the reason is because the credit bureaus charge the creditors, like mortgage companies and credit card companies, to report information as well as get information. So the credit bureaus make money coming and going, okay? So in some cases, creditors only report once every 90 days instead of once every month, so they can reduce the expense of reporting, okay? The site I recommend is creditchecktotal.com. For $1, you get all through reports and scores, and then I put that toll-free number on there. Oh, and by the way, I didn't provide you with a copy of the slides. If anyone wants the slides, I'd be more than happy to email them to you. Just send me an email when you get home, and I'll shoot you over the slides right quick, okay? Toll-free number to Credit Check Total, 866-506-7894. you call them up and you get a half-price deal. After the dollar, after 7 days, it converts to $30 a month credit monitoring. Now, it's good credit monitoring, but it's not worth $30 a month. So you call the toll-free number, tell them you want the inside deal, you get it for $14.97. I keep it myself because I have 24/7 online access to all 3 reports and scores, and it's updated once a month. And the other reason to keep it is because whenever there's a change in your credit report, they send you an email. So, for example, if there's identity theft involved, you can log on immediately and see that you didn't open that account, and you can call them and tell them that it's not you, close the account, etc., and take action. Okay? So that's a reason why. Beware of ads for a free copy of your scores. Some of them are outright scams. Okay? If you get on the wrong website, enter your personal information. It's just like phishing. They send you an email, you click that link, enter your personal information, and they go on a spending spree. Okay? So only go to verified websites like the one I'm recommending to you, because I've used it many, many times, hundreds of times. Okay? There are at least 3 different score models as well as 3 different credit bureaus. Mortgage lenders ask for all 3 bureaus. Credit card companies typically only ask for 1. So what that means is 3 different score models. I'll give you an example. There's the mortgage score algorithm, there's the online score, and there's the auto and the insurance score algorithm. Why do they have different score models? Okay? The mortgage scores are going to be the most conservative compared to the auto and insurance algorithms. An example of why that would be is that it's a lot easier to repossess a car than it is to foreclose on a house. Okay? So it's common when I pull credit for a mortgage situation and the consumer has their credit that they give to me, there could be a difference of as much as 10 or 20 points per bureau, mine being lower, the mortgage scores being lower, because the mortgage scores are the most conservative scores out there, typically. Okay? Credit score pie chart. Now you have a copy of this on the back page so you can follow along. Okay? This is really very illustrating. All right, the payment history is 35%. That's the biggest chunk of your credit score. It's simply whether you pay on time or not. Okay? If you pay on time, your scores will be higher, and that's, again, 35% of the total credit score. Amounts owed, 30%. That is on revolving debt. So if you have a $10,000 limit on a credit card, you shouldn't owe more than about $3,000 if you have to carry a balance at all. You do not need to carry a balance to have good credit. If you pay it off at the end of every month, that's great. Okay, as long as you use it, you're golden. Okay? But if you have to use it, try and keep it below 30% of the limit. So if it's a $10,000 limit, $3,000 owed max. Okay, now if it's around the holidays and you know you're going to get a bonus and you want to spend for the holidays and you go over, fine. As long as you pay it back down right after, your score is a movable feast. It changes. It goes up and down based on what you're spending and the payments that you make on a daily, weekly, or monthly basis. Okay? Length of credit history, 15%. Oh, and by the way, payment history 35, amounts owed 30%. Those basically 65% of your total credit score, you basically have total control over that. Okay? So you want to make sure that you're on time with all of those payments, and you respect those limits on the credit cards. Oh, one more thing. Sometimes people come to me, they want a mortgage, and they say, I got lates. My credit's not that good, and yet I pull their credit and the credit's flawless. Now, why did they say that? Well, what happened was they were 10 days late on a credit card, or they were 10 days late on a mortgage payment. They made the payment, they paid the late fee, okay, because typically it's charged even 1 day after the due date, but they were never 30 days late to the bureau. And a creditor cannot report you 30 days late to the bureau unless you're truly 30 days late, okay? So that's an example of someone having perfect credit even though they had a couple of late payments, because the lates were never more than 30 days. Here's another issue. If you have to be late on something, be late on a doctor bill, be late on a cell phone bill, be late on an insurance bill, because none of those report to the credit bureau. The only thing that reports are credit cards, car payments, mortgage payments, and student loans typically, or installment loans like an aluminum siding loan or roofing loan or something like that, okay? Or home equity lines of credit. But typically insurance, medical bills, and cell phone bills don't report to the bureau unless they're 90 days late, and then they report as a big negative, okay? So if you have to be late on one of those bills, but obviously pay that as soon as you can as well. Okay, length of credit history, 15%, okay? Most of us here who have gray hair or no hair remember Sohio before BP, okay? Now, I have a credit card in my wallet from Sohio/BP that I got in 1976, okay? And it's never coming out of my wallet because all other things being equal, I have a 30-plus year history in the bureau just based on that one credit card, okay? And the older you are in the bureau, the higher your score will be, all other things being equal, okay? Now, my sons, when they were in their 20s, they still had scores in the 700s, which are pretty good, even though they were fairly young. You know, their length of their credit bureau was maybe 3 years, 5 years, something like that. So you can still have scores in the 700s, even if you're young, and those are pretty good scores. Now, types of credit. I'll go back to my son again. He was buying a new car. He bought a new Honda Accord a few years ago, and I went with him because I like beating up car salespeople. And we struck a deal on the price of the car, and then Honda at the time was offering low-rate financing, 4.34%, I think sticks in my mind. But he did something unusual. He asked my son whether he had ever bought a car before, okay? And the answer was yes. My son had purchased a used car and paid for it better than agreed, you know, paid it off early. So he did qualify. Now, why did he ask him that? Okay, the reason is because if all you have is credit cards, typically your payments are 20 bucks a month, 50 bucks a month, $40, $60 a month, something like that. But a car payment could be as much as a house payment, you know, $500 a month or something like that. So it's a psychological thing about, yeah, you have the money, but are you prepared to make that big payment every month, okay? So that's the importance of having different types of credit on your credit report, okay? So credit cards certainly, car payments fine. A mortgage actually causes your score to go up a little bit because mortgages are indications of stability, okay? And those are some things like that underwriters want to see. And then the final thing is new credit of 10%. That's almost a negative rather than a positive, okay? That's how many times your credit has been pulled in the last 12 months, for example, okay? Now, a few credit pulls are okay, but I've seen people who have 20 credit pulls in the last 12 months, and that's definitely a no-no, okay? Your score does drop every time there's a hard pull. Now, the difference between a hard pull and a soft pull, when you pull credit on yourself, like going to creditchecktotal.com, that's a soft pull, okay, and it does not count. If a credit card company that you're doing business with already, or a mortgage company that you're doing business with already pulls your credit, that's also a soft pull and does not count and doesn't show up. If I, as a mortgage pro, pull your credit, that's a hard pull and it does show up, and a couple points are deducted from your credit report. Okay, question?
Now, what if I have an account with Chase and I want to get different Chase credit card? Is that considered a hard pull?
Yes. Yes. If you're getting a different card altogether, it's a hard pull. Question?
Why does an inquiry like that cause your score to go down?
Because the credit bureaus know that a certain amount of inquiries means that you're shopping for credit, okay? And they consider that a negative over time, all right? And the amount of pulls that you have in a relatively short space of time is probably what you're concerned about more than the fact that your credit is pulled once in a blue moon, okay? A typical example of that is going to a car dealer and having them pull your credit. Most car dealers will literally wallpaper the city with your credit report. A big no-no, okay? when you go and shop for a car loan, not the car, okay, either get it from a credit union or a bank, or go to Credit Check Total, download a copy of your report as a PDF, print it out, and bring it into the finance manager or the card dealer and say, look, do not wallpaper the city with my credit report. Here it is. Tell me what you can do for me based on this. Or pull it once, not 8 times. I can't tell you how many times I've taught this class and people do this and they say, oh my God, that's why I have all these credit pulls on my credit report, because I went to a car dealer and bought a car. Okay? So be careful about that. Question?
Just, I did the same thing. I went to lease car.
Uh-huh.
The dealer pulled that report. The lease company pulled it.
Right.
2 reports in one.
Exactly, exactly. Now, some underwriters will take a look at that and they will say, okay, it's obvious that a whole bunch of those credit pulls were all from the same transaction, and they'll discount it. But most credit bureaus will still ding your score by X amount per pull, and there's some logic here that I don't understand, but if your scores are lower, it's more to pull your credit than if your scores are good. You might drop 2 or 3 points if your scores are in the high 700s, and 5 points per pull or more if your scores are in the 600s or lower. Okay? So guard your credit carefully. Don't let anybody pull it unless it's an absolute necessity. Okay? Any questions on this? Employer, yes. Yes, employers would be a hard pull. Insurance companies would be a hard pull when you're first signing up with them for the insurance. Again, when they are just checking on you 6 months or 2 years later, that's generally a soft pull. Question?
Life insurance, health insurance, anything?
Most insurance companies will pull your credit. Absolutely.
Hey Ray, one thing, as you're answering questions,
Sure.
you try to answer the question in a way for the recording so that
Oh, sure.
the recording knows kind of what the question is.
Excellent idea. Excellent idea. Thank you, Jason. Okay, 3 items to keep off your credit report. Charge-offs. That's when you go so late on a bill that the lender actually writes it off. You still owe it, but they stop collecting it. Okay? And typically what happens when that occurs is that they sell that debt to a collection agency, and most of the time the collection agency is buying that debt at 10 cents on the dollar or less, especially if it's credit card debt, because it's completely unsecured, and there's very little things that they can do to you legally to get you to pay it. Question? They should not. They can put a negative thing on your credit if they own the debt, okay? But they shouldn't be able to pull your credit just without your consent. Maxed out credit limits, of course, we talked about that already. Your score could be 50 points or more lower when you have maxed credit cards than if you have low or no debt on your credit cards. It was very common when I first started originating loans 18 years ago that I'd consolidate debt on someone, pay off all their credit cards. Their score would be in the low 600s, and when I pay off the debt and consolidate it onto the mortgage, their payment goes down and their scores go up by 50 to 75 points per bureau, just because they have clean credit now.
Last year, we applied for a mortgage for a house, a construction loan,
Uh-huh.
and then I was shopping for a mortgage.
Right.
3 different lenders I went to. Now, could I have taken my credit report to each one of them, or they pull it?
For preliminaries, you could have taken it and given it to the loan officer, and that should have been adequate for that loan officer to analyze the credit and quote you, okay? But when push came to shove, when you chose a specific lender to do the deal, then they needed to officially pull credit to put that in the file. But for all preliminaries, you can take the credit check total one in. Question?
So it's not true then, because we did a mortgage, a couple mortgages last year, and on the first one early in the year, what they told us is you have 60 days once you pull the first one for a mortgage to pull other ones in terms of it affecting the credit, because they're assuming that it's
that depends on the lender that pulls your credit. Okay, it's not clear to me how they pull soft and hard. I don't know how they do that. I just know they do it. Okay. Typically, what happens is the lender will pull your credit initially, then the loan officer quotes you rates, signs you up, etc., and then the lender typically pulls credit again just before close to make sure nothing radical has happened. We hand out a sheet to our clients. It's a do and don't sheet, okay? Don't buy jewelry, don't join a health club, don't do this, don't do that, don't do anything out of the ordinary, because if you do, you could talk yourself right out of the loan, okay? I had a lady early on in my career go out and commit to $5,000 worth of furniture after we had given her preliminary approval, and guess what? She didn't qualify anymore. That extra $200 or $300 a month payment affected the debt ratio, and she was done, okay? So, in fact, let's talk about that. We'll leave that alone. On the bottom of your sheet here, 3 items needed for loan approval, okay? Just below the credit score pie chart. Number 1 is credit, okay? Obviously, that's very important. Generally speaking, a score of 640 or higher will get you a mortgage, okay? Now, there are some programs that will go down to 580, for example, and scores run from 350 on the low to about 850 on the high, okay? So 640 and higher typically will get you a mortgage. The best rates, of course, are going to be found with those in the 700s or up. And of course, as an investor, you want the highest possible scores you can get, okay? And I'll give you an example. I originate blanket mortgages, and generally speaking, if your scores are in the 700s, you'll qualify for rates between 5.5 and 6.75 on a blanket mortgage, okay? 300K and up, loan value, and a minimum 3 properties, okay? Now, if your scores are in the 600s, you'll still get that loan, but the qualifications are going to be tougher, and the rate will be higher, okay? Now, that's for a blanket mortgage. Typically, if you go conforming, you can get scores in the mid 600s, but your rate will be higher than it would be if you were in the 700s. So, having good scores is an important thing. Next is debt ratio. Okay, debt ratio is figured very simply by taking your total gross monthly income and taking 45% of that number as a rule of thumb. And if all the payments on your credit report total 45% or less, $4,500 or less, you're approved. Okay, so that's the simplest way to explain it. You know, if your income is $5,000 a month, then $2,250 is the max amount that you can spend on credit card payments, car payments, mortgage payments, student loans, etc. Anything that shows up on credit. Okay, so that's a go or no-go situation. Now, I have gotten loan approval for someone at 55%, but it was a special situation. So there's exceptions to every rule, but in general, 45% is the good number. And remember, that's your gross amount, not the net amount, not your check amount, but what the gross amount of the check is every month. That's how debt ratio is figured, okay? And the third leg is loan to value. Those in the mortgage industry abbreviated as LTV, okay? Now, the gold standard is 80%. Okay, our parents went to a bank when they wanted to buy their house with $20,000 in cash or in a negotiable instrument on a $100,000 purchase. They gave the banker or the realtor that $20,000, and the bank made them an 80% loan-to-value loan. $100,000 purchase, $80,000 loan. Everybody was happy, including the bank, because the bank very rarely took a bath on those loans, even if the loan went south, because there was $20,000 skin in the game, okay? Now, today, we regularly make loans all the way up to 96.5% loan to value. So on a $100,000 purchase, a consumer only has to put down $3,500 down payment through the FHA program, and of course, the programs and guaranteed rural housing programs can get you into a home for only $500 down in some cases, okay? Now, typically, the default rate on those loans are a little higher simply because the debtor in possession doesn't feel like they have a lot of skin in the game. So if they have a problem paying, it's a lot easier to walk away from that situation than it would be if they have, you know, a big chunk like 20K invested in the property, in a $100,000 property, okay? So those three things, credit, debt ratio, and loan to value, are the primary things that you need when you apply for a loan. Now, if you go to a conventional bank for financing on a non-owner occupied property, typically the banks are going to require 25% down plus closing costs, and they're going to require good credit as well. I don't know of too many banks that'll do loans in the 600s to a real estate investor with 25% down plus closing costs. Typically, you have to be in the 700s. Now, that's specialty, so don't quote me on that, but in any case, the higher your scores are, the better off you're going to be and the lower your rates are going to be, okay? Now, those are full doc loans, okay? You need to provide at least a couple years worth of tax returns if you're self-employed, or if you show real estate investment income, a couple years worth of tax returns. If you have W-2 income, you'll have to show that. You'll have to give a list of properties that you own, a list of real estate owned. You know, it's going to be a full doc situation. The loan officer and the underwriter will know you better than your own mother after they get through asking you for all the docs, okay? So that's an example of a typical mortgage transaction these days, okay? Back in 2005, if you fogged a mirror, I could have gotten you a loan, basically. So there we are. Okay, let's keep moving. Top 10 myths of credit. When I pay off a past due account, such as a charge-off or collection account, it will show paid and will no longer be negative. That's definitely not true. The most current 2 years history on your credit counts the most, okay? So that means if you have no late payments in the past 2 years from today back, your scores will be higher than they would be if you have late payments within the past 2 years, okay? So when you pay off a past due account, such as a collection, it may show paid, but it becomes a current zero balance collection, and your score actually goes down rather than up. Now that seems counterintuitive, and it is, but the reason why is because that most current 2 years counts the most situation, okay? Now on the flip side, that helps you. Let's say you've had a perfect payment history for the last 8 years, and all of a sudden life happens, and you have a $100,000 medical bill, and you have to file bankruptcy, okay? So you file bankruptcy, the ship gets righted, you reestablish credit, and you start paying on time again for the next 2 years. Well, guess what? 2 years later, FHA will give you a mortgage because you've demonstrated that that bankruptcy was a one-time event, okay? And that overall you're a responsible individual and you do pay your bills on time. So 2 years later, you get a loan. You apply for a mortgage, okay? Now, on the other hand, I've seen people, when I look at their credit report, that they've never paid a bill on time. There's nothing but collections, judgments, late payments, literally never, there's nothing good on that credit report at all. Those people don't need a mortgage, they need luggage, okay? So that most current 2 years. So let's get back to this collection now. Let's say a lot of people will find collections on their credit report, okay? They might find a 4 or 5 year old medical collection that no one even done them for. They didn't even know they had it until they went to apply for a loan and they were turned down because the loan officer said, whoever it is, you got a collection on your credit report. What's going on here? So they want to do the right thing. They want to pay off that collection, and their score down when they pay the collection, because now instead of a 5-year-old collection for $50 or $200, whatever it is, it's now a current zero balance collection, and even though it's zero balance, it's current, and it hurts you more because of that 2 year situation than it did when it was 5 years old. So the correct way to pay off the collection is to call the collection agency directly and say, look, you want the money, okay? I want that off my credit. And the collection agencies can and do remove stuff every day. They put it on, they have the power to take it off, okay? So the idea is to call them about the 20th of the month. And even collection agencies have budgets and quotas, okay? So you call them on the 20th of the month because they're much more likely to say yes as they get closer to the end of the month, and that gives them enough time to send you a letter stating, if you pay that $50 by the end of the month, we will remove it from all 3 bureaus. That's what you need to strive for, okay? And then gives you the time to send that $50 to them, or whatever the amount is, by the end of the month, okay? And then you wait 30 days or 60 days or so. You check your credit again at creditchecktotal.com and make sure that collection is removed. If it isn't, you call them up and hold their feet to the fire because you got a letter from them stating they're going to remove it. Now, that's the correct way to get a collection dealt with on your credit. They really want the money. That's all they want, okay? So you do that, and you get that collection removed completely, and now your score will go up rather than down because the collection goes away totally.
So you're saying to call the collection agency?
Call the collection agency. The address will be on the credit report. And you can also Google them to get the phone number if it's not on there. Myth number 2, if I succeed in deleting a negative item, it will just come right back on my credit report. Generally, once it's off, it's off. Okay, so that's not true either. Myth number 3, if there are negative listings such as bankruptcies and foreclosures that are impossibly removed from the credit report, that's not true. Okay, that's a myth also. Nothing is not removable from the credit report. Almost anything will come off if you apply the right lever. Now, usually that lever is money, okay, but not always, okay? Sometimes the report or the item was put on your credit report in error. It's not reporting properly, or it's a complete falsehood. It should not be on there, period, okay? And once you challenge it, they have 30 days to research it, and if they don't come back with an answer of some kind within 30 days, by law, the credit bureaus must remove it, okay? Now, I know a lot about credit, obviously, but I don't do credit repair myself. I normally refer people to reliable, low-cost credit repair companies that are much more expert at fighting the credit bureaus than I am, okay? So if you need that referral, let me know. Myth number 4, disputing the credit board is easy and any consumer can do it for himself for the price of a few postage stamps. Disputing is easy. Getting results can be very frustrating. And again, that's why I use a credit repair company and I don't do it myself. Myth number 5, if I declare bankruptcy, I can begin my credit report all over with a clean slate. That much is true, but bankruptcy is like the nuclear bomb for your credit report, okay? So you only pull that trigger if there's no other way out, okay? Like I said, paying everything on time for 2 years is going to result in a significantly increased score compared to other stuff. Myth number 6, if you're not satisfied with the results of your credit bureau's challenge, you may file a 100-word statement on your credit report explaining your side of the story. Creditors will read your statement and take it into account. Complete myth, okay? If you challenge something, all you're doing is basically validating the debt. That means you owe it, okay? The only time I would put a 100-word statement on the credit report is of identity theft. And then it's a generic statement, identity theft victim, please absolutely positively identify me before you grant me credit, okay? Myth 7, by changing numbers in my social security number or by using an EIN tax number, I can fool the credit bureaus into creating a completely clean new credit file under my name. Again, that's kind of illegal. We don't suggest that. It's much easier to fix your credit and then proceed, okay? Myth number 8, if I build enough good credit, it will offset my bad credit and make me credit worthy. That is not true either, okay? If there is only one 30-day late on your credit report, it could cause your score to drop by 50 points or more, okay? So absolutely make sure that you pay everything on time. Now, having said that, I know people personally who had an isolated 30-day late payment on their credit report, and they called up the lender and said, look, they fell on their sword. I made the late payment. I paid the late fee. I've never been late on anything else. Would you please remove that 30-day late from my credit because it's damaging my credit? And most of the time, the lender will remove it because it's just good business, okay? So I would use that in case you run across a 30-day late on your credit report. Myth number 9, I can improve my credit score by closing down some credit cards. We know that that's not true because I remember when I talked about the BP Ohio card in my wallet, okay? That's the other reason why that card is never going away, okay? Because it's the oldest in the bureau. Many times you close a credit card and you cause a problem for yourself because it's the oldest card in the bureau and your scores go down a little bit. Okay, myth number 10 is illegal for creditors to take a negative accurate listing off my credit report. Law requires that these items remain on the credit report for at least 7 years. Again, not true. The law reads up to 7 years or up to 10 years. Anything can come off the day after it comes on if you apply the right lever. Question?
Yeah, quick question on the credit card. So if something isn't the oldest card that you have, say it's a department store card that might be 2 or 3 years old,
Right.
is that still good to keep open?
You could probably get rid of a department store card if it's not the oldest one in the bureau without hurting your credit, okay? Revolving debt in general is stuff that you should keep and use. Many people have cards in their wallet that they haven't used in over a year. And I'm going to recommend that you leave here and buy a tank of gas with that card on the way home. I'm serious. That's not a joke, okay? Use it or lose it. Question?
Also, as a side note on that, if it's a higher balance or higher
Limit?
total limit, it's
Yes.
best to keep it open, so then it
Correct. Correct.
credit utilization.
Correct. Yeah, there's a lot of different ways to fix credit utilization. You know, if you're at 80% credit utilization, but you don't have any way of paying down on the cards, if you open a new card with a fairly high limit, now you've cut that utilization down to 40% maybe, okay? And you haven't paid a thing off, all right? So there's a lot of different ways to skin the cat. Okay, use goodwill letters to remove late pays. We talked about that. Increase your credit limits. We talked about that. Remove inaccurate negative information. We talked about that. Someone can add themselves as an authorized user on the account of a friend or family. That generally works too. If you have high debt, create a plan to pay it off. Like if you get a year-end bonus or something like that, or a tax refund, instead of going to Vegas on that tax refund, at least use a portion of it to pay down your credit card debt. Okay, what to do when the bank says no? You can borrow money from friends and family. You can use hard money. This is especially true of real estate investing, of course. You can use the business lines of credit that I offer or go conventional lending. With unsecured business lines of credit, there are no upfront fees. We only collect a fee if we perform. The only thing you pay is a few dollars for credit check total. Cash within 30 days of applications. The initial goal is 50 to 100K in 30 days, usually less than 30 days. If more than 100K is desired, then we can rinse and repeat. 200K is usually possible with excellent credit within 90 days. Cleaning the credit inquiries will be necessary between the funding rounds. So the first funding round generates 6 to 8 fresh inquiries on your credit report, and those need to be cleaned off between the first and second round of funding if your goal is to double down on what you qualified for in the first round. So if you qualified for 50 and you want 100, we can do that within about 90 days. And if you qualified for 100 and you want closer to 200, we can do that in about 90 days. Question?
When you say excellent, just quantify.
Yes, I can. Oh. Here's the 4 things that the underwriters look for. Did I do that? Yeah, I did. Okay, here's the 4 things the underwriters look for, and I will email this to you if you ask me. Number 1, no late payments at all on the credit. None. No bankruptcies, no foreclosures, no 30-day lates of any kind. Okay? If there's an isolated 30-day late from 5 years ago, we can probably deal with that. All right? But generally, the credit's got to look good. Secondly, old credit cards. They want to see credit cards of at least 8 to 10 years old, and typically older is better. Okay? The idea there is the underwriters want to see a long time on-time payment history. Number 3, they want to see high limits and low balances. Again, that 30% number, okay? At the time of application, no more than 30% owed on a card. Number 4, no or low credit pulls in the last 12 months. That's why we have you go to Credit Check Total and pull your own credit before we do anything, because we don't want to add hard pulls to your credit report before the time of application. So if those 4 things about a client, I can tell you whether they're approved or not, and I can tell you pretty much how much they're approved for as well without even knowing what the credit scores are. Okay? All of this is free. There's no charge. The only time you pay us our fee is at the end of the process after you have your credit lines in place. Okay? Now, your credit is what determines how much you qualify for. You can have a brand new business. These are business lines of credit. So that's your personal credit report only. I'm sorry, they report to your business credit report only, not your personal credit. Okay? The only thing that shows up on your personal credit is the fresh inquiries created by the first round of funding. So that means 6 months from now, you can buy a car and there's no debt ratio issues. Or a year from now, you can refinance your personal residence and there's no debt ratio issues because these lines of credit don't even show up. They only report to your business credit profile. The business can be brand new. We don't care. It's not like you have to be a 3 or 4 year old business with good credit report or good sales before you can go to a bank to get funding. Okay? Question?
So I'm established with a credit card company and I want to increase my balance.
You mean a limit?
Yeah.
Yes.
Is that a hard or a soft pull?
Most of the time it's a hard pull. But it's just one pull because banks typically on credit cards only pull one bureau, not all 3. Okay? Question?
What is this business line of credit? I don't understand.
It's exactly that. It's a business line of credit. It doesn't, except for the inquiries, nothing shows up on your personal credit. You wind up with a Paydex score by Dun & Bradstreet on your business rather than on the personal. And that's the way it should be if you're a real estate investor. You want everything to be on the business side, not on the personal side.
Must you have an LLC?
You can have an LLC. Most of the time people have an LLC, but you can have a sole proprietorship, I don't recommend it, or a C Corp or an S Corp. Any form of business ownership. Okay? Question?
There was a mention of being secured versus unsecured. What is
Okay. If you have a HELOC on your home, a home equity line of credit, that's securitized by the home. There's a mortgage on your home as a result of that. The unsecured business lines of credit means exactly that. The only thing that secures that loan is your signature. That's it. That's why the underwriters microscope your credit to make sure you have good credit. Because previous performance is an indication of how you're going to perform in the future. So if you've got a 10-year history of on-time payments, that's really good for the underwriter to hang their hat on, to approve you. Okay? Someone else had a question? Question?
Why don't you recommend sole proprietorship?
Well, actually, Jason could probably speak more on that than I can, but basically it's a liability thing, okay? You know, if one of your tenants sues you because they fell and slipped on ice and you're a sole proprietor, they can take whatever you got, okay? But if you're in an LLC, it tends to shield you a little bit, okay? And again, I'm not an attorney. I can't speak intelligently about that, but check with an attorney or a CPA. Question?
One thing my husband and I can't figure out with the business line of credit is you're using it for real estate
Yep.
and rehab. And then you rehab it and refinance.
Right?
Who does the bank pay? Like, where's the note on
Okay.
how does that work?
There is no note, okay? Only your signature guarantees repayment. There's no mortgage.
So then how do you deal with the bank when you refinance?
Okay, when you refinance, now you're putting a mortgage on the property and you're taking the cash you get from the refinance to pay the unsecured business line of credit off so the funds are available again for the next deal.
So if the house, you bought it for 30, eventually it's worth 100.
Right.
You would get the 100 from the bank?
No, typically, as an investor, non-owner occupied, you're limited to 65 to 70% of the appraised value. And although there are some lenders who will allow, who don't require seasoning, okay, typically they require 1 year seasoning on that loan. So you need to hang on to the property for a year before you could take advantage of the 100K appraisal value as opposed to what you actually bought it for and invested in it to fix it up. Question?
Do you give out proof of funds letter on the unsecured?
Yes, I do if your credit approves. Yes, absolutely. Absolutely. Okay, one more thing. Okay, other than the initial inquiry, there is no impact to your personal credit reports. We just talked about that. Unsecured business lines of credit report to your Paydex business scores created by Dun & Bradstreet. No collateral is required. It's a true line of credit. No mortgage is given. When the line is paid back, it's available again for reuse. It's perfect for fix and flip, zero line, zero interest, okay? It's a permanent line of credit, no requalifying every year. Available to all business entities, including sole proprietorships, not incorporated with DBA files, C Corps, S Corps, LLCs. DBAs only are okay. Applicant does not need an existing business to qualify. You can create a brand new business and qualify. Question? Yes, but business credit is different than personal credit, okay? You can max that credit line and not worry about your score dropping. The only thing that business credit worries about is whether you pay on time or not, okay? And a score of 80 on your paydex score means you're golden, okay? It's not like you have to get to 100. 80 means you've paid within terms, basically net 30, okay? Okay, the requirements are stringent. Minimum 700 scores, all three bureaus, at least a 10-year history, no negative items, preferably high revolving limits, 10K or more. My ideal candidate has a $25,000 limit on a credit card that's old, 8 to 10 years old or older, only owes $3,000 or nothing on that card, but used to owe 20 and paid it back, because that tells the underwriter that this client knows how to manage large sums of debt responsibly, and they're the ones who qualify for larger lines initially. Now, if you only start out with 10K, you'll still qualify, except your initial lines won't be quite as high because you don't have that experience with larger lines, okay? Low credit utilization, co-signers are acceptable. I know going in that only half the population will qualify, okay? So obviously, co-signers are freely acceptable and no problem, okay? Someone can stand in for you. Now, when the lines are granted, your name and your company name go on the account, or your co-signer's name and your company name goes on the account. And after the accounts are established, you call up the lender, the bank. We deal with the top 40 banks in the country, and ask for a sub-account to be set up so that you have access to the funds too. Okay? Yes? Yes. Yes. We use the one that Credit Check Total uses, okay? Right. Well, again, Credit Check Total provides all three bureaus. It's run by Experian, but they provide reports from TransUnion and Equifax as well. And the credit bureaus are in cahoots with one another, even though they're supposed to be competitors, okay? Because every one of them has a website like this. TrueCredit is run by, TrueCredit.com is run by TransUnion, and they offer all three scores, all three bureaus, okay? But we don't use them because they cost more than Credit Check Total does. Question? Of course, absolutely. I encourage you. I encourage you. Send me an email. Okay, unique features. Initial interest-free period of 6 months to 1 year on all the lines of credit. We guarantee that, okay? Low rates for unsecured debt, no hits to your personal credit, lower rates if you pay on time, and higher limits if you pay on time, okay? So that means that, let's say you qualify for a $10,000 line of credit, and you pay our fee based on the $10,000, okay? You'd owe us $1,000, 10%, okay? And a year from now, the credit line is doubled to $20,000. We don't participate in that at all. You did that. You paid responsibly. You used the line responsibly, and you don't owe us a dime other than that, other than the first initial line that you owe us. Okay. New corps and startups are okay. Another great benefit to this type of funding is the ability to approve a client's personal credit profile and score. I can't tell you how many times investors have said, yeah, I'm carrying a lot of credit card debt because I'm using those credit cards to fund the deals, okay? Well, once they get the lines of credit, they can transfer all of those balances onto the business lines of credit, and their personal credit scores go up because now they have no balance, okay? A HELOC or other personal loan may be secured to assets, in many cases the business owner's personal residence. Again, you want to try and get that off your personal residence, because if we have a problem, you know, if we have another downturn and you have a problem with those business lines of credit, okay, you're not going to lose your home over it. You probably don't need to file bankruptcy over it, okay? Okay, we talked about that. Acquiring business lines of credit improves your personal credit. Plus, banks issuing cards are always happy to see clients moving balances, so transferring personal credit or debt will strengthen their personal and business profiles and credit ratings dramatically. Okay, I think that wraps it up. Any questions? Question? Good question. Excellent credit. Thank you. What is the interest rate after the initial 6 to 12 months interest-free grace period? The rate's going to vary from about 7 to 15% depending upon how good your credit is, mostly at the time of application. So if you have scores close to 800, for example, the rates are probably going to be between 7 and 11. If your scores are between 700 and 750, probably the rates are going to be between 11 and 15. Question? Yes. Yes. Yeah, we don't encourage you to use these lines of credit to buy and hold, okay? Because the rates are higher. You should use the funds either, here's two different ways to use the funds. You can either buy for cash, make the repairs and flip, or use hard money and, thank you, I feel like I'm shouting, or use hard money and use my lines of credit as the down payment amount, okay? Because most hard money lenders will not grant you 100% financing, okay? They'll only give you maybe 60%, okay? So you use our hard money, our lines of credit for the down payment, and then get the rest of the money from a hard money lender. Question? Uh-huh. That's your decision. Correct. When you take the funds from the lines of credit, you control how much you take, okay, at any one time. Right. Correct. Correct. That is true. You only owe interest on what you borrow, okay? For example, if you borrow $25,000, most of the banks will have you repay either 1% of the unpaid balance, which would be $250, or 2% of the unpaid balance, which would be $500 a month. Okay, so that indicates either a 5 or a 10-year amortization period. It's not like a 30-year term where you borrow 25 and you pay $100 a month over 30 years. Okay, so you're going to pay it off a lot faster. However, you control how long you have that money borrowed. Okay, there's no prepayment penalty. That's why it's great for buy, fix, and flip, because you can pay it back immediately as soon as you make the profit, and the line goes to zero, the balance goes to zero, and the funds are available to borrow again. Question?
The 10% is on the limit or the amount drawn? The 10% your fee?
Our fee is on the limit. So, for example, if you qualify for $50,000 total, you would owe us $5,000, and you could pay that right out of the line of credit. You do not have to come out of pocket with any cash. Okay? Okay, question?
Say with LLC, do you do then one of the partners for that, or do you need both?
So if you have a 2-member LLC, okay, just one partner is all that's needed, whoever has the best credit. Okay? And again, co-signers are freely accepted. I had a couple in Chagrin Falls qualify for $170,000 between the two of them. They applied simultaneously with 2 different LLCs. Okay, and even if one of the LLCs is brand new, it doesn't matter, because 95% of the approval process is the credit itself as opposed to how new the LLC is. So it just depends on how much you want to borrow.
And Ray, you said that you do soft pulls only do your own pull, so there is no, are there hard pulls that end up coming on
Yes,
credit line from those?
from the banks themselves. Here's how this works.
Do you get hit with first?
We found the back doors, if you will, to these lenders, okay, the top 40 banks in the country, okay. If you have good credit, you can go anywhere and get a line of credit. It's not a secret, okay? You can go down to your local bank and they'll give you a line of credit, but chances are it's going to be tied to your home. It's going to be a home equity line of credit. You'll get a pretty good interest rate, probably below 5%, and, but it's going to be limited to how much equity you have in the home. And you're not going to be able to get to 100% anymore. Chances are they're going to limit it to 80% because banks are ultra conservative on loan to value with lines of credit for obvious reasons, because all the HELOCs that were granted before 2005 became literally worthless after the downturn because property values went down so much, okay? Problem with getting a HELOC is it's tied to your personal, and it's going to report to your personal credit, and you won't get 6 to 12 months interest free. So our claim to fame is we've perfected getting you multiple lines of credit all at the same time so you can make a meaningful investment, and we guarantee everyone comes with 6 to 12 months interest free, and we guarantee everyone only reports to your business credit profile, not your personal credit. That's our claim to fame. Okay?
But they do still show up as hard pulls on your personal.
Yes, the lenders will pull 6 to 8 pulls typically in the first round of funding to get you the lines of credit. And the primary reason is because even if you have flawless credit, because these lines are completely and totally unsecured, they max out at around $25,000 per client per bank, okay? So if you want $100,000, you're going to have 4 to 6 lines of credit to make up that $100,000, and again, all with 6 to 12 months interest free and only reporting to the business credit line, the business credit report. Any other questions?
Who could use that? Hey, look, you know, I mean, money's a big part of this business. I always tell everybody there's 2 things we need to make this thing work out good. Besides education, we need deals and we need money. And it should be an even task when it comes down to what you're trying to accomplish. And I learned that at 18 years old when I realized that if my ambitions were big, my funding sources had to be equally as big to make it happen. And learning how to leverage the opportunities that are out there that best fit you are essential, and what Ray's talking about tonight may fit what you're looking for. And you know, he's got his contact information on here for you. You know, there's different forms of lending out there that are available to us as investors. You know, we tap into private money, we tap into hard money. Like, you know, he had hinted towards going to the local bank, but again, that's going to change the whole approach. You know, I just had an investor come to me. She was thinking about getting hard money lending, and I said, well, what's your credit like? And she said, it's pretty solid. And I said, well, just see if the bank can give you a line of credit, you know, before spending 8% on a, you know. And so she was able to go do that. She was able to leverage. And I said, just make sure you're not going to need your credit for anything in the near future, because it is going to play against your income to debt ratio. But so she was able to go to the bank and pick up $250,000 line of credit to begin her real estate investing business, and that's a pretty good start. And you know, there's a lot of different opportunities. And outside of lending and of itself, we have a very high value for training our investors on how to be business owners, and a business owner that knows how to go and leverage what they know to get the money that they need to get the deals done. We turn people who didn't know they were real estate investors into real estate investors by leveraging what they have, money, to what I have, which is knowledge. You see, and you leverage what you have in order to make that work. So your priority in this business should be to gain as much information as possible. That's why we do stuff like this. That's why we have the training. I appreciate Ray coming out tonight to share this information with us. Let's give him a hand.
Thank you.
You know, go on our meetup page if you want to see all of our upcoming events that we have. It's meetup.com/smartstartrealestate. Smartstarttoday.com is the university's website, and get the information on there about our upcoming courses that we have. We do daytime, evening, and weekend classes, and you know, we're looking for people who want to make a business out of this, and we're committed to walking you through it for the long haul. So do we have any questions for the night? I always make sure I want to get you guys out of here when we say we're